Hello, everybody. Welcome to my Intermediate Accounting 17th edition video solution walkthrough. And this is for the authors Kiso, Weingan, and Warfield. This is Wiley's Intermediate Accounting 17th edition. The questions used in this presentation are copyright 2019 by John Wiley and Sons. All rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express written permission of Wiley. The solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley or any of my other employers. So welcome. I just want to give a huge shout out to Wiley to thank them for allowing me to make these videos for my students and for other people. So let's get to it. Okay, so when we're in chapter 15 in Wiley, and I'm going to put a link to something below. There's something called Z Library. And this is z-lib.org. And what's pretty cool about Z Library is that when we think about it, is that this has a ton of basically resources, including the textbook that I'm using right now. So as you kind of go through and look at this is a pretty big deal as far as having access to free materials. So check it out, zlib.org. One of my colleagues, John Russo, turned me on to this. And it's absolutely phenomenal for students, especially as we're kind of moving towards a land of free textbooks. Okay, so we've got recording the issuance of common and preferred stock. So we've got Kathleen Battle Corporation was organized on January 1st, 2020. It is authorized to issue 10,000 shares of 8%, $100 par value preferred stock, and 500,000 shares of no par common stock with a stated value of $1 per share. The following stock transactions were completed during the year. Okay, before we go any further, I want to take just a few moments just to kind of talk about this. When we form a corporation, what is going to happen is you're basically going to file an articles of incorporation that's typically going to be filed with the particular state. And so let's just kind of take a break here and I'll try to find something for you. So actually where I am right now is I'm at the California Secretary of State website. And when I go to the California Secretary of State website, I'm going to go down to their business section. And then I'm going to come over here to business search with free images. And I want to see if I can actually find this. It's like in and out. It's almost lunchtime someplace. Okay. So right over here, we've got In-N-Out Auto Sales Services, In-N-Out Burgers. Okay, so if I go to In-N-Out Burgers, okay, and got to request a paper copy. But right over here, this is basically, this will tell you about where exactly is, or where the corporate headquarters are for In-N-Out Burgers. And so this is here where it is. The agent for service of process is, this is probably their attorney actually. But let's go ahead and take a look at this real quick. If we just kind of look at the amendment to this and see what kind of pops up. Okay, so here we go. So when a corporation is formed, you're going to basically have the articles of incorporation. And in those articles of incorporation, one of the many important things that's going to be listed in there is essentially how many shares are you allowed to how many shares do you have authorized? And so right over here, we kind of look at this. This was back in April 10th of 89, is that basically the capital stock. So they're amending their prior one, which we can't actually look at, but they're going through here and they're basically saying that social consist of par value, 10 cents each. And so it should be split into 100 shares. So what that probably meant is that beforehand, they maybe had 200,000 shares and now they're basically upping it to a higher amount. Let's go back here and take a look at another amendment to their articles. And right over here, let's see. So they're deleting Article 7. Let's see if they've got anything else that's good with regards to shares. Okay, so here we go. Here's some more amendments. And again, when you're looking at the incorporation documents, you have to go through and basically file. Basically, you have to kind of go through here and you got to file your initial articles, but you can always go later and go through and amend the articles of incorporation. So that's kind of what's happening here. And they're obviously, they only made, we struck gold on this first one right here, which was that they're actually listing out the number of shares that they have authorized. So generally the way this is, again, the way this is going to work is, so when we see this information here, this is going to be coming from its articles of incorporation. And the other comment I also want to make on this as well, while we're kind of here, is that I have never seen no par common stock. What I will usually see is you'll have a par value of the common stock that is set very, very low. Let's just go to Facebook. It's typically set very, very low. The reason why it is set so low is because that is actually the minimum shareholder or the maximum shareholder liability if the company went bankrupt. What does that mean? If the company sold shares for below par, the shareholder actually has an obligation to make that up. And typically when we're investing as a shareholder in the corporation, we can just lose our investment. We don't owe anything else. So if we look at this here, this is 0.00006. So it's traditionally set very, very low. Facebook, and I've probably mentioned this in some of my other videos, why do they have Class A and Class B? Because there's different voting rights. And by doing that, Zuckerberg can maintain the ultimate control of the corporation. Okay, so that's a little bit about authorized shares, right? So the authorized shares are what we're coming out and stating. Typically, I would be seeing common stock at par. So as I'm going through and doing this question, I'm going to call it common stock, right? Whenever you see this C/S, common stock, APIC is additional paid-in capital. Okay, so right over here. So we start up here on January 10th. So on January 10th, okay, so we issued $80,000 shares of common stock for cash at $5 per share. So let's do the easy part first. I'm receiving cash and I'm issuing 80,000 shares at $5 per share. So right over here, I'm going to debit cash for $400,000. Okay, so that's going to be my first part right over here. And when I do the credit part, I have to break this up into two components. It's going to be common stock at par, or in this case, it would be no par. And then you're going to have additional paid-in capital common stock. Now, the way this works and the way that why we're going through and setting it up like this, and again, you can refer back over here to Facebook, the par value is so low because it's at a fraction of a cent. These amounts, it doesn't even reach $1 million. So it's below it's like 499,000 or below. And so if we multiply that out, we could actually figure out what it was, but that's for another day. So what we're going to do is we're going to take 80,000 shares times the $1 stated value. Okay. And so this is going to give me here $80,000. Now, the rest of this, I'm just going to put to additional paid-in capital common stock. Or over here, this will be 320, 100,000 less than everybody's favorite number. Okay, so right over here, then I'm going to call this to record issuance of common stock. Okay, so that's what we're doing for that one right there. I issued 5,000 shares of preferred stock for cash at $108 per share. Notice that if we were dealing with a publicly traded company, you typically will not see preferred stock, or it has not been issued. And it's really because it can create a lot of types of confusion with investors. So typically we're not going to be using preferred stock. The thing that I've seen more of today is you create two different classes of shares and you attach different voting rights to those shares. But again, if we're using preferred or we're using, common or whatever we might be doing, just always think about the ownership impact, right? And that's really very, very important for like a lot of entrepreneurs, is that do we want to be giving away the entire company? Do we want to be giving up control? And it's a double-edged sword. So, but at the end of the day, a lot of times this is going to be dictated by the financing. Okay, so we've got March 1st, 2020. So I issued 5,000 shares of preferred stock for cash at 108 per share. So let's do the easy part first. So the cash I'm receiving is 5,000 times 108. And this is giving me a total over here of $540,000. Okay, so now we're going to call this preferred stock. And then we're going to have additional paid-in capital preferred stock. Okay, now I don't know the answer if we sold the stock below its $100 par value, if that would be something that would be owed to a company, but I would be very concerned about that. If you're selling something at a discount to par value, that can create a problem for an investor. Okay, so right over here, the next thing we're going to go ahead and do is we're going to have preferred stock at par, additional paid-in capital preferred stock. So it's at $100 par value. Okay, so it's 500,000. And then the difference, we're just going to basically take to additional paid-in capital preferred stock. And this here is going to record issuance of preferred stock. When it comes to descriptions, for me, I always like to have a description. I always tell my students, as long as you're describing what's happening, not like Tom Brady likes his balls a little bit deflated. Oh, that's his footballs. I'm just kidding, Tom. I'll go number 12, right? So, but in all due respect, it's one of those things where you want to have a journal entry description. And it's just basically because a lot of people are going to be reviewing your work. Okay. Now over here, 4/1/20. Okay. So over here, we issued 24,000 shares of common stock for land. The asking price of the land was 90,000. The fair value of the land was 80,000. Okay. So in this case here, you don't want to go with the asking price or what the selling price is. You want to be going with what is the fair value when we're going through and recording that land. So in this case here, we are receiving land. And over here, I'm going to record that over here at 80,000. Okay. Now, when it comes to the par value, right? So I'm going to have common stock at par, additional paid-in capital common stock. So what I'm going to do here is this is going to be 24,000 times 1. Okay, so this is going to be 24,000. And then my additional paid-in capital common stock is going to be the difference between these two, or 80,000 minus 24,000, or a total here of 56,000. Okay, and this is to record issuance of common stock for land. Okay, so I'm just saying that we got the land as a result of issuing the common stock. Now, is that, again, this is going to probably be driven more by tax considerations, but again, that's something that can happen, but we do want to follow along with the fair value of what is being done here. Okay, so we come over here to May 1st, right? By the way, if that land was being contributed by a shareholder, right, or somebody who's going to be owning stock, would it be ideal to get an appraisal? I would say absolutely yes. So that's something just to kind of keep in the back of your mind. Okay, so we got over here on 5/1/20. I issued 80,000 shares of common stock for cash at $7 per share. Well, we're kind of now just doing this. We're kind of just doing the same thing, right? So when we issue common stock for cash, what I'm going to do right over here is I'm going to say, okay, I'm now getting basically over here, 80,000 shares at 7 or 560,000. And again, what we're doing here is, make sure I got that right, May 1st, 80,000 shares at 7. So this is going to be 80,000 times 1. And then over here, the difference is over here is going to be, the difference is going to be 480,000 or 560 minus 80. Okay, if you're new to my channel or how I go through and do things and why am I crediting common share, like common owner's equity accounts, right? So the thing in accounting is that the way that you always want to be approaching whenever you have a transaction and you don't know what to do, what I like to do is to write our balance sheet equation, which is our assets equals liabilities plus owner's equity. Okay. And this is going to be expenses, revenues, and then debit, credit. Okay, so if I'm receiving cash, cash is an asset, right? I increase my assets with debits, I decrease my assets with credits. I'm debiting cash right over here for the full amount of the money that I'm receiving. These are owner's equity accounts. They reflect the amount of stock that has been issued to a company shareholders. So when I'm going through and recording these, I'm going to be showing increases to those or the issuances of those with a credit. So that's kind of how I'm going through and recording this. Okay, August 1st. Okay, so I issued 10,000 shares of common stock to attorneys in payment of their bill of 50 grand for services rendered in helping the company organize. Now, I actually screwed this one up because I thought it was actually going to go to organizational costs, but that's like my tax brain coming in, and that has to be amortized over 5 years. But over here, this is going to be organizational expenses. And we're going to go ahead and record that at the amount of the legal bill right over here of 50,000. Okay. And then I'm just going to do the same thing. I'm going to credit common stock at par. And how do I credit common stock at par? I am giving them 10,000 shares of common stock. So this is going to be 10,000 shares at $1 per share. And then my difference is going to go to additional paid in capital common stock. So this is going to be 50,000 minus 10,000. Okay, so this is going to be to record issuance of shares for legal fees relating to org expenses. Okay, so again, that's how we kind of go through and do it. Now, organizational expenses. How do I record an expense? Oh, DCER. I record an expense with a debit. That's why I'm debiting organizational expenses. If you ever have an accounting question that you don't know the answer to, if you memorize this, you can pretty much always get the right answer. Okay. Now, I issued 10,000 shares of common stock for cash at $9 per share. Okay. Oh, this is getting exciting. This is why all internships in accounting are paid, right? Because it involves too much repetition. The moment you do something that's not, the moment that you do something twice under California law, you violate the internships, which is always why I will never talk to an employer who won't pay my accounting interns or my students. Okay, so right over here, I've got 10,000 times 9. Okay, so this is going to be 10,000 shares times $9. This is going to be 10,000 times $1. And then my difference is going to go to additional paid in capital common stock. Okay. So That's over here. That's basically going to be September 1st. Now over here on November 1st, I issued 1,000 shares of preferred stock for cash at $112 per share. Oh, well, I'm doing preferred shares now, so can I just go through and copy this down? Absolutely, yes. And by the way, you will have use of Excel for the CPA exam. Strongly, strongly, strongly recommend you take a class using Excel. Irvine Valley College has amazing ones. Always got to give Carolina and Dixie and Rupa their plug because they do a great, great job of helping our students. Okay, so right over here, I'm issuing 1,000 shares at $112 per share. So over here, this is going to be 1,000 shares at 112. Okay. Now my preferred stock at par is going to be 1,000 times 100. And then over here, my difference is going to be 112,000 minus 100,000. Okay, so that's just kind of like a brief warm up that I do like about the KESO textbook of just kind of like, okay, how do we go through and record equity transactions? So that is exercise 15-2. Let's now take a look at exercise 15-3. Okay, so stock issued for land, 25,000 shares reacquired by Elixir for $3 per share were exchanged for an undeveloped land that had an appraised value of 1.7 million. At the time of the exchange, the common stock was trading per share on an organized exchange. Okay. So over here, we're going to prepare the journal entry to record the acquisition of land, assuming that the purchase of the stock was originally recorded using the cost method. Okay. So right over here, when I go out and I repurchase my own shares, this is something we're going to be calling treasury stock. Okay. So how does treasury stock work? Best company to look at for this example is the Depot, and that is the Home Depot. And if I look at the financial statements of the Home Depot, and I have to get out of Zoom, not that Zoom, but that Zoom. Okay, so right over here, if I look at the quarterly report, so I want us to go down to the balance sheet, and this is just what is absolutely insane. So par value 5 cents, that's way too high, but it's okay. Home Depot's doing well. So I've got over here 10,000 shares issued, right? So that's coming from their articles of incorporation. But then I have, assuming I've got 10 million shares authorized, excuse me, or 10 billion shares authorized. I have issued 1.7 billion shares, right? And also we want to look up here in millions except per share data, which means that the only per share data we're going to be really looking at is going to be down here with this desk over here. So when I look at this, right, so 5 cents authorized, 10 billion shares are authorized. I've issued 1.7 billion shares. Now, when you look at the outstanding shares are less than the issued shares. And why is that? It's because they have repurchased massive amounts of their own stock. In fact, they have repurchased so much of their own shares, they have bought back $72 billion of their own shares of stock. Okay, think about it. Had they not done that, right, if they just would have let it fly, and you look at their total assets, that's almost a doubling of their total assets. This is how much they've actually bought back. So when we look at treasury stock, like how do we treat it? We're going to treat it over here. It's not a contra equity account. It's just going to reduce the amount of retained earnings. A lot of students would say it's like, oh, it's like I buy back my own shares and therefore it's an asset. It is not an asset, because when you buy back your own shares of stock, it's just really kind of reducing the amount of shares that are actually outstanding. So we're going to show treasury stock as a negative balance or as a debit balance to owners and owners equity. Just remember, typically when I buy back treasury stock, so over here, what exactly happened in exercise 15.3? Well, basically, I got 25,000 shares that were reacquired for $53 per share. So basically, I went through over here. And basically, I originally went through and reacquired these shares, right? So over here, I basically said, you know, I'm basically debiting treasury stock and I'm basically crediting cash. Okay. So that's what happened when I bought back my own shares. Okay, this amount which shows a negative amount in the owner's equity section. Why? Because it has a debit balance, right? Typically, when we have owner's equity accounts, liabilities and equities will typically have credit balances. So over here, when we look at this in the owner's equity section, treasury stock, 72.7 billion negative balance, right? Because it shows a reduction of owner's equity. Okay. So over here, right? So I'm acquiring land. So let's kind of go through and try to figure this one out. So when I look at this, so 25,000 shares reacquired by Elixir for $53 per share were in exchange for an undeveloped land that has an appraised value of 1.7 million. At the time of the exchange, the common stock was trading at $62 per share on an organized exchange. Now that is very important, because if this is what it's trading at on an organized exchange, this may be the better value in terms of how to value the land. So if we value the land, okay, at say over here, okay, so if we value the land at 25,000 times $62 per share, we get basically 1,550,000. Okay, so that's going to be the value of my land, or this is going to be 25,000 times $62 per share value or price on the organized exchange. Okay, so right over here, we've got our land at 1,550,000. Okay, so what do I go through and credit? Well, what I'm going to do is I'm going to credit treasury stock for 1,325,000 because this is what I paid for it, right? I've got to now take that off of my books. I'm reissuing it. So I'm going to credit treasury stock over here for this 1,325,000. Now, the thing we would want to say is like, well, we've got a gain. We made money. Well, you really didn't. You're dealing with your own shares. And if you show a gain on the shares of your own sale, on the sale of your own stock, does that sound like manipulation? Yes. Maybe it's time for me to go to law school. I did. So the difference here is we're going to put this to additional paid-in capital treasury stock. And it's going to basically be the difference here between, oh, wait, hold on. Sorry. Okay, so it's 1,325,000. That's what the value of the treasury stock was. So over here, we're going to have 1,550,000 minus 1,325,000. So over here, this is going to give us to 225,000 to record land acquired by issuing 25,000 treasury shares. Okay, so that's how I would go through and prepare the journal entry. Now, this is interesting. What if over here now, I feel comfortable doing this? Why? Because this is at, basically this amount is below the appraised value, right? So if I were to record this at appraised value, the problem would be is that now, well, I'm now artificially then, so say if I were to do this at the appraised value of 1,700,000, right? So say if I was to do it like this, then I would have the treasury stock over here at 1,325,000. And then this over here, I would be showing additional paid-in capital treasury stock for 375. Okay, so if I were to go with the appraised value, now the problem with using the appraised value is if I take 1.7 million and divide that by 25,000, it's basically I'm giving up $68 per share. The problem with that is that over here, the value of the stock is only $62 per share on the open exchange. It's an organized exchange. So the reason why we want to go through and not do this, but rather do this, is that this is going to be, it's going to be a pretty well reflective. And if you've ever heard of an appraiser say, well, what do you want it to appraise for? That should be telling you enough that it was happening back in 2005. So major reason for the collapse of the real estate market. So that's kind of some insights into how we kind of go through and record like these different items. So and again, but what if the appraised value is below? What if the appraised value is like 1.4 million? Then I would actually adjust this down, because then it almost looks like now you're overstating the value. You're basically putting something on the books that's below. But the problem with that then becomes as well, if you're really trading at $62 per share, then why are you giving up 25,000 shares? Okay, so that is exercises 15. Where were we? 15.2 and 15.3. I want to thank Wiley again for allowing me to share these solutions with you. Don't forget to like and subscribe, and I look forward to seeing you on the next video. Have a great day.